Hello and welcome back again to EK Public Voices podcast. And rain, hail or shine, we are here today. With me I have David Sokulsky from Carrara Capital to talk about everything about markets, the economy that we live in, and what the outlook is for the year. But before we start, very interesting journey from New York, the Caribbeans, Melbourne, Sydney, very much all around the world. Investor, hedge fund manager, as I can say. But if you'd like to share with our viewers a bit about yourself,
sure,
that'd be great.
Well, I grew up in Newcastle, which is just north of Sydney. I did a lot of things, but I mainly played sport when I was younger and ended up playing a lot of cricket. It was actually in the Newcastle senior team at 16. And so I moved to Sydney primarily to play cricket, and university was just a secondary thing for me. For better luck or worse luck, I ended up being relatively smart and not as good at cricket as I'd like. I wanted to play a bit more cricket, so I actually got first class honours at university and got offered a scholarship in Melbourne to do my PhD. I'm not, as people would I'm not a rocket scientist or a pointy head or anything. I'm a very normal person. So I thought doing a PhD was a great opportunity to play 3 more years of cricket, which is what I did. And I made the Victorian squad at one stage, but it sort of didn't go too much further than that. But what it did do, it allowed me to really fuel a passion for investing and finance and the markets. And I honestly didn't have that before I moved to Melbourne. So that was sort of the start of my journey in financial markets. When I left Melbourne, I came to Sydney and worked for Macquarie Bank at the time, Macquarie Group now, in their hedge funds team, and that led me to New York, where I transferred into their investment banking division, and again looking at building alternatives businesses, which was wonderful. The only bad thing about my experience was that I moved over in there September 07, which just essentially was the start of the GFC, which again, from a fund manager now's perspective, to live and breathe that environment and to have that experience is invaluable.
Yes.
So at the time it was pretty nasty, but now I look back and go, I learnt a lot, and hopefully putting those things in place now in the portfolio. Yeah. I was lucky enough to invest with a wonderful hedge fund manager called Denali Asset Management, and I ended up leaving Macquarie and working with their owner and their portfolio manager, who was a wonderful investor. And he really sort of taught me the ropes of investing and macro investing. I did that until essentially we moved back to Australia. So over in the US, we traded everything from gold to German bunds to Australian equities to everything, wheat, soybeans. And then when I moved back to Australia, I ended up heading up investments for UBS Wealth Management, which turned into Crestone, and I was the founding CIO of Crestone Wealth Management, which again, wonderful experience and really enjoyed my time there. I got the opportunity to run an Australian equity fund, which was listed at the time. So I left and ran that for about 3 years, where we performed very strongly. But then the time came again when it was time to do something on my own, and I launched Carrara Capital. Yeah. And Carrara Capital is now my business, which I run, and we run a global macro alternative fund. Yeah. So we do have an equity bent to it, but it's very much a global macro fund where we're looking at macro themes, we're looking at big picture economics, to see how we should manage people's money, and really importantly is we try and manage downside risk. Yeah. Such that capital preservation is key, but then we also want to make money on the upside. Yeah, absolutely. So this current period of volatility is something where we really shine through in terms of our performance, and our Q1 numbers sort of show that. Yeah.
100%. And I think I've been watching the reports closely and looking forward to working closer with the team as we move along this trajectory. But still remember the time when we met was pretty much on the same service office.
Yes, it was, yeah.
Back at Winter Garden.
Yep.
And, it was interesting to see the dynamics and start building up the conversation, confidence and trust around it. So thank you for that.
No, it's great. It's been a great relationship, actually. It's good to see your business grow as well.
One burning question I have, India versus Australia, who's the better one? Honestly.
Well,
in cricket.
That's a tough one. I'm not sure whether you're going to kick me out of the room or not.
Well, that depends. I do have an Australian passport, so I'm a citizen here. My loyalty is divided.
I think it goes in periods, but they're always very competitive test series. I think in the shorter form of the game, India's certainly got the edge at the moment. In the test matches, I think India's probably had the batting edge.
Yep.
And Australia's always had the bowling edge.
That's true.
And each test series has sort of gone back and forth depending on those two things. They've both got wonderful players who can change matches. So each series is different.
Who would you rate as the greatest Indian cricket player?
Well, Kapil Dev was a little bit early for me. My dad always said that he was wonderful. The best I saw would have to be Tendulkar.
Yeah.
But I always loved watching Sehwag bat.
Ah, yes. Yeah, definitely.
He was always wonderful to watch, and probably got overshadowed by Tendulkar a bit and didn't get probably the acclaim he deserved. Yeah, I'd say they were the best.
What about Kohli?
Kohli's wonderful. I just think he's a dash below.
Yeah.
And one of the reasons I say that is Tendulkar faced bowling attacks which were arguably much better than what Kohli's faced. And that's got to be considered.
Yep.
So outside of the Australian attacks, I think for the last 10 years, the global attacks have been weaker than what they were, back in the sort of 90s.
Okay. And what about Australia? Who would you rate as one of the best players on the Australian side?
The best player would definitely be Shane Warne.
Shane Warne, yeah.
And I think as a batsman, Ricky Ponting would certainly have to be up there.
I would say so.
I think they're probably the standouts when you look at, playing, batting 3 is much harder than batting 6. And I think, you really, Ponting played before the wickets really flattened out. So I think that's why I'd sort of give him the edge.
Okay.
But probably the best innings I've ever seen in Australia with Australia and India is Rashad Pant.
Oh, right,
And
yes.
I think he scored about 160 4 years ago. If
Yeah,
I've got
yeah,
it
yeah.
Right. I was at the SCG that day.
Right.
And that's when the Australian attack was just on fire. And his innings was absolutely superb. Brilliant.
Fascinating.
Yeah.
I need to rewatch that again. Talking about bettings and attack around it into your work sphere and the environment we live in, comparing the GFC and COVID and the market crisis that we are seeing today, what sort of similarities are you seeing between these 3 cycles, or are there any similarities around it?
Look, I think the similarities is that the sell-offs that we've seen have been very sharp. And it's been hard to position a portfolio before they've happened, and you really had to have a strategy which is nimble and active enough to deal with it as soon as the news has come out. Now, outside of that, they are 3 very different crises, if you like. The GFC was very much an internal plumbing crisis, if you like, where you had a huge liquidity issue happen with the banking system. That was sharp, sudden. Everyone, including the Fed, didn't expect it. But once it happened, we realised that the internal plumbing of the financial system was highly interrelated. And to unwind it, they had to effectively have an enormous monetary stimulus, sending rates effectively to zero, implementing quantitative easing to keep the system alive. When you look at COVID, again, very, very different because one, we didn't know it was coming.
Yep.
Now, when we say we didn't know it was coming, each of them had probably 3 or 4 months of lead time with talk of things happening, but they didn't actually happen. And again, COVID was an external shock, which no one could really see the full extent of or really predict what the full extent would be. And again, we had a government intervention, this time by a fiscal stimulus primarily, which created a very V-shaped recovery. This time, I think it is very different because we don't have the scope to have that monetary and fiscal stimulus like we had last time. And hence, although we're up something like 12% in 3 weeks, which is quite amazing when you think about that, but it doesn't feel like we should have the same V-shaped recovery this time around. The governments don't have the ability to stimulate the way they did before. With inflation at sort of 3% and oil close to $100, inflation is a real concern if they let fiscal or monetary policy get out of hand. So we've got a flow-on effect from oil prices in particular, which is higher inflation, limiting central banks' ability to cut rates. And then we've also got an impact on consumption where we're seeing a huge drain, if you like, an energy tax almost on consumers. And that probably hasn't hit certainly equity markets yet, but that's going to play out a lot longer than what we saw in the V-shaped recoveries of the GFC or COVID.
How much do you think the turnaround that we have seen in the past couple of weeks is driven by complacency or an immune feeling of retail investors to whatever that's happening in the world because it's successively continuous amounts of unprecedented events that we are facing, and together with the rise of passive funds at the same time, so passive ETFs. Do you think that has kind of gave way to the recovery as well?
Yeah, look, I think it has. I mean, passive funds are certainly driving the ups quicker and the downs quicker. Yes, you've seen that passive flow impact. I think you've now got the algorithms impacting markets a lot more than what they have ever done. So any headline or any news is being reacted to, irrespective of whether it's fake news or real news.
The famous words now, fake news.
Well, we live in a society where we don't know what's real.
That's right.
Until we get some kind of secondary validation.
Correct.
That I think is really important. Thirdly, we've got a buy the dip mentality.
Yes.
Because every time markets have fallen for the last, well, since COVID at least, and probably since the financial crisis, markets have bounced back very quickly. So a down sort of 7-8% seemingly is a signal to buy for people. All those are sort of fuzzy, this is what we think's going on. I think one thing that was definitely warranted was that over the last 6 months, even before this sell down, we've had a real number of quality stocks which haven't gone anywhere. Now, I'll highlight just Nvidia as an example, where Nvidia didn't really move from August last year. So you've got probably the best company in the world hasn't gone up in price in 9 months.
Yeah.
And it came back down, and I think people sort of saw that and went, well, hey, how is the price of oil going to $100 really going to affect some of these really high quality companies? And even if consumption drops off, or even if the central banks can't cut rates, does that mean that the model for these companies is broken?
Yeah.
And so you did have several companies which was fundamentally warranted. Not everything, and I think we've seen some of the weaker countries not bounce back as hard, Australia being one of them. We're much later in the cycle, consumption's getting hit much harder here.
Yep.
We don't have the AI innovation versus, say, the NASDAQ, which has rallied really strongly. So I would say this bounce back is really interesting, where some of it's unwarranted. Those macro risks still exist. We're yet to see the flow-on effects of consumption decreasing and inflation increasing, but some of it's certainly warranted, and that's where I think we have been, and we are certainly in going forward, an environment where I think active management and really looking at specific opportunities is much better than just blanketly buying equities.
Yeah, agreed. I definitely like the approach of active management, and that's how we construct portfolios within EK as well, is looking for active managers more so, especially in market volatility in cycles like this. You want a manager who's able to move quite quickly and nimble enough as well. So this whole drop with tech stocks and this sell-off in the software as a service stocks, part of it,
Saspocalypse,
that's the word. It must have gotten into the stage of it being oversold. Like companies like Atlassian, for example.
Yeah, I would say, and I think people really get technology wrong from an investment perspective. If this period's done anything, it's really to highlight how wrong people were. And by that I mean, you have the hyperscalers, which are spending hundreds of billions of dollars. And then you've got the semiconductor supply chain, which is benefiting from that. That's where they're spending it. And then you've got the SaaS businesses, which have always essentially been outsourcing of businesses to a SaaS company. And then you've got the software companies, which have facilitated it. So what we did previously is just bucket everything together and go, everything's tech. It's all in the same sphere, so they all should go up. And what that meant is you had companies trading at 60, 70 times earnings, which were completely unwarranted. And we saw this in Australia, even with Xero and WiseTech, which are completely different businesses to the tech stocks overseas. And so you can add Seek in there as well. And they're all considered almost exactly the same. They're tech, so they should trade twice the multiple of the market, 3 times the multiple, which is wrong. They're individual businesses. Coming back to your question, I think we have a situation where some things have been oversold dramatically and now appear to be really good investment opportunities.
Yeah.
Some things have sold down dramatically, but are still trading at 35, 40 times earnings because they were at 70 times earnings. I think, and again, it comes back to that active management argument. Now is a really good time to sort of dig through a lot of those companies that have fallen in price to work out where the opportunities exist.
Yeah.
Not all of them will survive. Not all SaaS businesses will survive. Some will get killed and some will remain fantastic businesses.
Yeah.
The difficulty now is being able to decipher which ones survive, which ones thrive.
That's right.
And certainly, if I can use WiseTech as an example, because it's one of the stocks in our portfolio, we did not buy it until a couple of months ago because it was always incredibly expensive. After it fell, it started to become very attractive. Now, could it fall further? Absolutely. But I think when you look at its business model, when you look at its opportunity in logistics and its situation, in the markets it effectively, controls, you've got a very good investment opportunity.
Yeah.
Other stocks may, fall considerably. So that's where I think you've got to be really careful with blanketing things together.
Yeah.
It is a very specific market at the moment, which I think is fantastic.
Yeah. What cues do you look for in, say if you're valuing a company or an index, what cues do you look for a turnaround before you go, right, the thesis is adding up? Is there any particular analysis or particular financial concept that you pay attention to?
Look, I do look at valuations relative to earnings growth is probably the biggest one that I look at, just in terms of purely a really raw but sort of pure valuation method to say, what am I willing to pay for it? Once it comes into that attractive range, then it's worth paying more attention to. The PEG ratio, which that's referred to as, if something's trading at a PEG of 3, so let's say it's at 30 times earnings with 10% in earnings growth, for me that doesn't interest me. Maybe a wonderful company may go up 100%, but it's not in my sort of discipline of what I see as attractive. For us, the way we build our portfolio is very much from a macro perspective. So we're looking at big macro themes which should drive the markets forward and should benefit from those societal changes that we see every day. So AI is being driven by, is leading to two things: the semiconductor space, which has to be bought in order for AI to move forward. So we love that space, that semiconductor supply chain. The energy transition, you've got to fuel the whole AI boom. So how do we do that on old grids? So that might be the actual electricity grid, the transition, building that up. It might be things like nuclear, which is in our portfolio. We think, so natural gas is another big one, which we think is a great alternative for economies to switch to. They're two examples of thematics that we really like. We've also got gold in our portfolio from a deglobalization perspective and the way central banks behave. So we very much build from a top-down perspective, looking at sort of 6 to 8 themes on the equity side, and then macro themes. So precious metals, long Australian dollar, long US bonds at the right time. From that perspective, for the tailwinds are the most important thing for me. Then from there, I want to pick the best 2, 3, 4 companies and maybe an ETF that benefit from those tailwinds. And then I know I don't have to be exactly precise and say, look, the company's trading $280 and the DCF valuation is 286 and therefore there's X amount of upside. What I know is that if it's trading at 200, if I think it should be trading at 250, I wait for it to trade at 250. I know it's got those tailwinds and the thematic drivers behind it, and I pay a fair price for it. I'm not bottom fishing for deep value, and I'm not paying excessively for growth.
That's right.
I just want to pay fair for something that's going to have a 1 to 3 year sort of thematic tailwind.
Given your background of working with family offices, high net worth, ultra high net worth families and individuals, in market cycles like we are seeing right now, where would be a gap that a lot of these families would often overlook in your experience of working with them?
It's a great question, and it's a very complex question as well. The key for most families, I think, is really to have a top advisor that does look at, strategic asset allocation and largely sticking to what they think is the path forward, not picking the next hottest thing, because that comes and goes. What we have seen a lot of families do over probably the last 15 years is they have tended to go into the hottest things, and they do tend to jump in a bit late and not realise the repercussions. Now, we saw it with venture capital 10 years ago, and now we've got a lot of people tied up in VC funds with no liquidity, and those VC funds have no one to sell the underlying companies to. And I don't think the end investor really understood what the ramifications of that investment was. I think we're seeing a very similar thing now with private debt, and we saw everyone rush into it, not realising that their money is locked up usually for a considerable period, and not understanding really what's under the hood. So they're just sort of going along with the crowd and not realising what they're actually invested in and what the risks are. And look, we saw the same thing with the tech stocks. Everyone just rushed in, not caring about which ones they were in, not really knowing the industry at all. And then, then they get caught with a 20% downturn. I think they're probably the biggest negatives that I've seen with a lot of private investors. The positives is that they have been very accommodative and open to investing in alternatives, which, is obviously my area. But I think it's a place where you're not just subject to markets going up and down, and there's nothing you do about it. So alternatives give you the opportunity to manage that volatility and to manage your exposures when the time's right to maybe increase risk or decrease risk. So I think that's probably the biggest things that I've seen from a lot of the families. What I'd sort of say is, again, having a good plan is really important, and not just getting caught up in what I'd call the barbecue chat, which is, I'm in this private fund, I'm in that private fund, and everyone goes, wow, I'm missing out. I should be in that too.
It's a very common trend, and I think most advisors can vouch for that. We often get that conversation with clients. My friend and my business partner or something is in this fund and I want it too. And that can be a downfall for a lot of the investors. When too many people rush in, the old saying, isn't it? When too many people are going in, it's time to exit out of a strategy.
Just when everyone's trying to exit, there's no liquidity.
That's it. And just like you saw the long lines outside the ABC in Martin Place of buying the gold at the peak of gold prices, and then a slight pullback and the crowds vanish
exactly
quite quickly. Talking about the plumbing issue of the banks during the GFC versus the private credit issue right now, there's a lot of speculation that this could be, it's got similar hallmarks of it being a second GFC. How do you see that panning out in the private credit space?
Look, I don't think so. I don't think it's anywhere near a second GFC, mainly because the size of the market is nowhere near what the size of the market was for the GFC. Remember, with the GFC, we had the derivatives being owned by multiple banks all at once, and you're into a leverage system where everyone was, levered counterparties to each other. Credit is very different to that, and I think there's a couple of reasons. And one, you don't really have that leverage.
Yeah.
Can people lose money, and will they lose money? Probably, maybe. But there's certainly not the counterparty risk, say, with the big banks on the back end, which would cause a fundamental, deterioration of the banking system. And if you like, the creation of private debt is the exact opposite of that. It's because of the structural changes from the bank's lending policies, which allowed these individuals or firms to go out and lend in private debt versus the banks lending that money.
Yeah.
So it's actually taking the risk away from the financial system into a handful of funds, managers and investors. So for society, if you like, a very different risk proposition, and I would argue probably a much better risk proposition.
Yeah.
For investors in it, obviously they're going to be on the hook if things turn down. The problem with private debt, and look, I'm a supporter of it, by the way. I'm not saying it's bad or negative, but every deal is different, completely different.
Yeah.
It's not like if you and I go and buy a Nvidia share, it's exactly the same share. If you go and do a private debt deal and I go and do a private debt deal, they're completely different. If you've got, let's say you're invested in 3 private debt managers and they've each got 100 deals on their books, you're invested in 300 individual private debt deals. Now, will all of them go down? Highly unlikely. But will some of them suffer? Maybe.
Yeah.
Probably.
Yeah.
But you don't know. So I think with private debt in particular, you put a lot of faith in the manager of that fund. So you have to have extreme confidence in that manager. If you do, if you know where they've made their money, if you know how they monitor risk and incorporate risk into their process, then that's a very different story to another manager.
Yeah.
Who is taking excess risk in a deal and maybe having excess fees in the background, and their deals may be suboptimal. That's the biggest problem, that we just don't know because it's so idiosyncratic.
Correct. That's a very valid explanation around it, and I completely agree with that viewpoint. If you were to receive 50 million investment into the fund, where would you be looking to park?
Look, I'm really happy with my existing portfolio.
Yeah.
I have just in the last day taken a little bit of risk off, just because this rally's been so solid. But I haven't changed the portfolio. I've just taken position sizing down and taken my net exposure down. So from our perspective, we've got good positions in currencies where we have been long the Aussie dollar, which has been a good trade for us. We've been long 10-year bonds, which again has been a good trade for us. And the way we think about these things is, if we have a flight to safety, people want to exit equities, then they go into bonds, and US bonds rally, and we get a little bit of a hedge from the equity sell-off. If not, I bought 10-year bonds when they were trading at about 445, which I thought was too high, 445%. So that comes down to 425, and we make money on it just fundamentally because it was overpriced. So, on the macro side, we really like that. We still like gold and silver, but you're not getting the reward for it at the moment given the volatility. So we have just brought that back a little bit. Certainly want to add to it. And then our equity themes, amongst a host of things, I've mentioned it, the semiconductors, we've got an Asian logistics and infrastructure theme, we've got an energy transition theme, which I mentioned. We've really liked emerging markets. We went into emerging markets at the end of last year, and that was Korea, Brazil and India. Korea and Brazil have performed exceptionally this year, and India's been a bit of a laggard, but it's bounced back this month. So, and again, I think given that the first two have rallied pretty hard, we'll see whether we get an opportunity to get back in there. India, I still think, has got a lot of upside to come. So we've maintained that position. And the other one, which we have liked for a long time, and out of all our portfolio, it's been really the only thing that's cost us this year, is our exposure to Chinese equities. And things like Alibaba and Tencent, where they are going to be winners from this AI race there. If you like, you've got US competing against each other, and then you've got these two giants, which are really going to benefit from everything that grows. And there's a few other companies and ETFs within that, but I would deploy the $50 million into our existing positions which are a range of those thematic ideas, and some of those hedges where can potentially pay off either way. So things like bonds and precious metals.
And what are your views about Europe moving forward?
Europe's a really tough one because valuations have come down over the last month or 2 months where it does look attractive. And we also had European banks as a theme, which performed really well for us in December and January, and I actually took that off at the end of January because of that credit risk that you mentioned. There's a bit of a discussion around some private credit funds locking up redemptions and things like that. So I actually just didn't want that risk in my portfolio. So I took that off. But Europe's got two big things, I think, and one's a big negative and one's a big positive. The big positive is that they need to spend money. Because the economies of Germany and France are probably two of the worst developed markets in the world at the moment. And the only way for them to avoid recession in the near term is for them to spend. And they've announced that they're going to do that on the defence side of things. And their banks are cleaned up dramatically from what they were. So post GFC, the European banks are very different to what they were previously. We're just not seeing the growth coming through. And we're seeing them being outcompeted, particularly by the Asian producers. And the auto sector is probably the biggest sign of that. They're being left behind. The structure of the European industries are struggling, the economies are struggling, but the governments have got to spend. And they do have scope to decrease rates because inflation there is not as high as what is in Australia or the US. So that's probably the positive where you can see companies benefiting from that. The big negative is that they are not purely, but they are very dependent on Russia for energy. And I wouldn't want to be dependent on Russia for energy in this environment. And for that reason, I'm avoiding Europe at the moment because we just discussed how markets react to news flow and things like that. If we saw a news report that was genuine that Russia, say, stopped exporting gas to Europe, now we're coming into summer, so it's not such a big issue, but if that happened at the start of winter, Europe would be in a lot of trouble.
Catastrophic,
When you've got that one big risk overhanging that investment, I'd be a little bit particular about it. But there's a lot of great European companies that, say, benefit from Asia consumption.
That's right,
Now, we held LVMH for a while. It was probably one of the most expensive stocks, and we didn't buy it for that reason. Sold down. We do like the Asian consumer as a thematic, so we bought that stock. It actually didn't perform as well as what we wanted, so we cut it. But now I sort of look at it and I go, this is looking attractive again. When you look at global economic growth, which has slowed down, and we are sort of late cycle, economic cycle, the question is, where is the growth going to come from? It's still coming from emerging markets, even though it's slowed. I think India is still the fastest growing, China is still the second fastest growing major economy. Now, do the Chinese government, as an example, just allow growth to continue to slow? Or do they, as they have done historically, have some economic stimulus to help the economy? Given what we've seen historically, you'd have to think that they will, if they need to, have some economic stimulus. A company like LVMH is probably one of those ones where you're always watching it and just deciding when is the right time to buy. And for every fund manager, every individual, that's going to be a different time. I'm probably going to be a little bit more patient than a lot of people and just sit back and wait for it to be a really good opportunity. But that's the kind of thing where I think at the moment European companies can perform really well. Absolutely. Mercedes is another example. Wonderful company, cars are great. It has rallied back now from where it was, but they're ahead of most of their competitors on the EV front. But again, I wouldn't buy it at these levels. But at the right price, that becomes attractive.
Last question around this bit. Do you see EV being a consistent theme that's going to rise up even further?
Yes, is the clear answer. But I think the two things that have surprised me is, one, how competitive it's become so quickly. The amount of EVs now on the market is just incredible, particularly in Australia. I'm not sure what's in the US, I'm presuming it's the same, but even if you have a look at utilities, trucks in Australia,
that's right.
You've got an enormous amount of EV choices now, whereas even a year ago, there was almost none. So the range of competition is huge, and we own BYD. I think BYD is one of the best companies in the world.
Agreed.
We've owned that for a long time, but it is facing competition challenges. Will it continue to grow, or will other companies sort of overtake it or steal its market share? That's a question that I think is pivotal for them as an investment. But so that's the first thing, just the amount of EVs which have come through, which was always seemingly difficult because creating an internal combustion engine car is very different to creating an EV car. So it creates a very different manufacturing plant, but they seem to have come along very quickly and a lot more competition. The second thing is, with all that competition, I think the consumer has been very slow to adopt the EV. This oil spike may change that, and probably has changed it already. Even speaking to people around town, they're starting to adopt the hybrid. They're like, we like the hybrid model. But yes, we will definitely get there. But I think it's going to be a bit slower than what we think. and I think it's going to be hard to make money from that space as an investor.
That makes sense. I mean, middle ground, as they always say, is the best option around it. Those are my questions for today. Thank you very much. I think it's quite a valuable insight around the big themes that we're looking out for in the market for the year, the sort of mentality that investors should have when they're looking at asset class, asset allocation, and where to park their assets in arguably another period of unprecedented market and probably geopolitical movements around the world.
Yep.
Final question, if you were given a choice of continue running a fund or on the cricket field?
Well, growing up, I always wanted to play cricket for Australia. You know, look, I got close, but still very far away. I would say I'd rather run my fund, to be honest. Like, I absolutely love it. I love the challenge. You know, I love the markets. And when I realised I wasn't good enough at cricket, you know, investing became my passion, and I do love it now. So
and the market loves you, and you're great at what you do.
Thank you.
That's what it is. Thank you very much.
Great.